Well, the stock market got to see that inflation data it was waiting for, and it got its answer. Not surprisingly, that answer is very clearly apparent in the price action given what we saw in the numbers. Nasdaq breaking to a new high, the S&P at its high but certainly up. So what is it that was in this data? Why was this the reaction? We're going to take it apart here, take a look at how the markets responded, but more importantly, take a look at what comes next. Because perhaps the biggest question, as ever, for anybody that's actually participating in markets is, okay, so we got what we got today, and we can have any kind of academic conversation about it that we like, but the real question is, what has this market done for us lately? Where are we going next? That's what we're going to explore here on Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live. Here's a view, first and foremost, on the day's performance to get a sense for what the price action told us this data was all about, because as ever, that is the most important of all the perspectives, and we can clearly see stock markets liked it. S&P up 1.07%, Nasdaq up 1.27%. The view on rates clearly seems to suggest that the markets read this to be generally supportive of rate cuts. We can see barely any change at the long end. In fact, a touch higher on rates there. But at the front end, the 2-year rates come in meaningfully. The 2-year down almost 0.9%. Gold basically doesn't go anywhere. Crude oil still doing its own thing, down 1.3%, but really not deviating from its recent ranges, just oscillating the past several days. The dollar, though, matching the overall mood here, a little bit weaker. Euro up 0.5%, yen up 0.2%. Bitcoin also taking a positive step here in the context of a generally risk-on day and a weaker dollar. So it seems like the markets looked at this data and said, oh, okay, this is fine. Rate cuts on. And on that basis, risk on, dollar down. So what did this data have in it that took the markets in that direction? The headline number comes in a little bit softer than expected, 2.7% versus 2.8% expected. The core reading comes in a little bit hotter, 3.1% versus 3% expected. So choose your own adventure. That's really the name of the game for this jobs report, because if you wanted to be concerned, as the Fed is, about tariff-based inflation, you got your report. But it wasn't consistent enough for the market to conclude that it will derail a September rate cut. And in fact, when we look at the pricing, we can see that the likelihood of a rate cut in September has increased today versus yesterday. Here was yesterday. We were sitting at about 86%. We've now gone up to 94%. The likelihood that we stay unchanged went down. The possibility that we might get a relatively larger rate cut fallen off the menu here. And indeed, we can see that this spook in and around the U.S. jobs data and sort of adjacent things that got us thinking that ahead of the jobs data, that Fed announcement and sort of things that revived a more hawkish perspective. We can see here we were much closer to 50-50 a month ago. Well, that is nowhere on the board here. So in the context of whatever occurred here, the market said, yeah, this September rate cut is going to happen, and its chances have become likelier. If we look at the overall outlook for policy, it hasn't changed very much. Markets are still at about 50 basis points for this year, and they're still at about 3 rate cuts for next year. That's 2 cuts this year. Ostensibly, that's September, and then another one sometime either in October or December. That's when the meetings are. And for next year, markets are at 67 basis points, which essentially comports to at least 2 cuts. That would be 50 basis points. And most of the way to another cut after that, to a third cut, such that the likelihood of that third cut is about 68%. So better than even. Needless to say, what this does is continue to mark a dovish contrast with what the Fed's own thinking is. As we've said before, the markets and the Fed are basically on equal footing for this year. The market thinks 50 basis points. The Fed agrees. 3.9 would be down from 4.4. That's 50 basis points for this year. For next year, however, the Fed sees just one additional cut, and the markets are on the dovish end of that still. So the lens through which we are looking here seems still to be what the markets want is more easing. What the markets want is more rate cuts. They don't necessarily buy the Fed's argument for delay. And their thinking is all of the cutting that the Fed is not going to do this year, they're going to have to play catch up with next year. So at least that much remains unchanged. Now, what was it in this inflation data that got them thinking that this cut is coming? Well, looking at the internals, they continue to look generally supportive of a status quo. Most inflation still sitting in the service sector, but the share in goods continues to increase. In fact, at a contribution of 0.22 percentage points, this was the biggest contribution from the goods sector to overall inflation since June 2023. Moreover, the thrust of where inflation is coming from is very clearly more potent in goods than it is in services. So while services continue to be the biggest overall component of inflation, it actually diminished in terms of its contribution to the headline a little bit, whereas the contribution from goods increased. This is not to say that services didn't power the increase in inflation. It did, because it's a much bigger part of the whole. But there does appear to be some kind of a handoff here, and the kind of handoff that you would expect were you to be concerned that goods inflation is going up because we've increased sales taxes on those goods. Because lest you get confused, that is exactly what tariffs are. They are a sales tax on imported stuff. That, of course, makes the price of imported stuff go up. And so, not surprisingly, the inflationary thrust is on the goods side. Moreover, if we disaggregate CPI, we set shelter aside by itself because it is something of a separate component onto its own. Obviously, this is not as responsive to the usual sort of import-export and certainly tariff dynamics that you might expect. So we take housing and set it aside. We look at core goods and core services, excluding housing, and obviously in that they are core, they are also excluding the price of stuff set on global markets, food, energy. Okay, what do we see? Inflation has been going up in both instances, goods, services. In goods, it is now the highest in over 2 years, going back to here, June of 2023. In services, it's also increasing. These year-on-year readings are also increasing, but this one is only the highest since December of 2024. Moreover, if we look month-on-month wise, that's the bars, not the lines, goods increasing in July, services decreasing. So if you wanted to see that goods are becoming a bigger part of inflation because of tariffs, you can see it. Tentatively, early days, but you can see it. If you look at the Fed's perspective on the level of force behind the trend, as it were, you can see what happens to these annualized readings that the Fed looks at, where it takes the 3-month reading and annualizes it, the 6-month reading and annualizes it, both headline and core, to get a sense not just at the year-on-year readings, but where the immediate thrust is. And you can see that, indeed, month-on-month, core inflation has been going up, and it's been going up since May. It went up in June, it went up again in July. That hasn't yet shown up in 6-month core, which is holding relatively steady. If you look at what's going on in 6-month headline, it's actually continuing to cool. In fact, it's been cooling since February and continues to. And if you look at the 3-month headline, it popped in June and hasn't really gone very far in July. So if nothing else, what you get here is kind of a mixed bag. The 6-month trajectory for headline still is favorable. For core, the 3-month is starting to tell you that maybe things are starting to turn in the wrong direction. But it's not convincing and it's not consistent. What you certainly don't have is a clear sort of inflationary ascent here. Instead, you have a descent into what, broadly speaking, looks like a leveling out, but not exactly a meaningful melt-up. And so with that, it looks like the markets go, okay, well, nothing has changed, but time is moving. And this is another piece of data that then will help to get us to a September rate cut, because as long as this isn't going the wrong way, the Fed is going to start running up against its calendar, and it only has but so many meetings to do 50 basis points, which it's been arguing for all year. So why wouldn't that cut occur? Especially as you get more dissents on the FOMC. Now, what then becomes interesting is whether these numbers can be taken at face value. And by no means are we saying that the data is somehow corrupt or manipulated. All that nonsense, I think, is generally irrelevant for the most part, because you can have an academic conversation about the veracity of the numbers, but from a trading perspective, everybody just needs a single yardstick. And as long as everybody's operating from the same yardstick, that's what markets are going to do. And the yardstick hasn't changed. The quality of the data in that yardstick may have been degraded, and almost certainly is degraded, because we're using about 30% imputed values in CPI now, which is way off the charts for the historical norm. Even during COVID, it was lower than this. And when you reduce staffing at the BLS by significant amounts, when you cut BLS resources, you end up with less of an ability to get accurate data. Shock of shocks. But from a trading perspective, if the yardstick is there, that's what the markets will use. and just operate as though they will take it at face value. No, when we say whether this data is real, what we mean is the absence of greater inflationary risk from the tariffs, though, of course, as we see, it's not like it's not there. It's there. But it's not anything scary at this point. And so the question is this absence of a much stronger thrust actually reflective of the tariffs being relatively benign, or is somebody else footing the bill? And in this sense, we're going to be paying close attention later this week to PPI data, the Producer Price Index, a measure of wholesale inflation, to see if we can tease out just how much we can take the end CPI result at face value. And you can see the expectation here is higher inflation across the board. Higher for the headline from 2.3 to 2.5, higher for the core from 2.6 to 2.9. Month-on-month changes all expected to be positive, whereas, of course, in June there was standstill. And we've already started to see goods inflation creep into PPI. This is PPI final demand, and you can see that over the past several months, it's already started to arrive. In fact, in June, we had the highest wholesale goods inflation since January. So it's starting to happen. But much more importantly, at the beginning of the curve, here, what we find is that we have wholesalers eating the tariff cost. In fact, what you see here, this is note, whereas this is final demand, this is intermediate demand. And what this is the price for trade services. In this case, this is the cost of doing business at the front end of the curve. This is margins for wholesalers. And at the intermediate demand level, this is the very beginning of the US-based supply chain. So stuff arrives from wherever it arrives from. The people that receive it and begin its journey through the US supply chain, be it to the distributors downstream, which then deliver it to stores, be it to people that need whatever inputs have arrived to then make final goods. This is the very, very beginning of the supply chain and the margins there. And you can see massive margin contraction at the start of the year. In fact, the sharpest that we'd seen since going all the way back to 2013. So we're talking a 12-year reference point here. And over the subsequent months, things haven't maintained the cadence, but they've certainly maintained the direction. Margins continue to deteriorate. What this is telling us is that there's your inflation costs. They're just being eaten. They're being subsumed into margins at the beginning of the supply chain. Ostensibly because firms at this level of distribution do not want to undermine demand downstream, and so they're not passing on the costs. They're eating as much of them as they can. And even then, by the way, as we can see here, this is increasing. So goods inflation going up at the wholesale level, goods inflation going up at the retail level. So it's starting to break through. But one might surmise it would be breaking through much more so if you were to have a straight pass-through here, rather than these companies eating the costs. What does all this mean? Well, we can see here that we started this year with a growth scare around the introduction of the Trump administration's tariff policies. We know that this happened in the context of a growth scare, because if it had happened otherwise, it would have happened back in November during the election cycle, and obviously it didn't. Markets held up here. In mid-February, the S&P 500 started to go lower. Against that backdrop, not surprisingly, Fed policy expectations became more dovish, all around this idea that what you'll have is some sort of a growth scare on the back of these tariffs, and maybe even something structural. That would be this panic right here. What we've seen since then is that we've basically held on to all of the net easing that we're looking for. It's reshuffled somewhat from being mostly, oh my God, we're going to need it in 2025, to no, it's going to be mostly next year, as the Fed is catching up, since they don't really want to jump the gun here. Stocks have obviously recovered because, in large part, whatever institutional and market structure risk ran out of steam as a concern here once it became clear that the administration is not, after all, immune to market discipline and will put tariffs on even a 90-day hiatus when the market gets quote-unquote yippy, to borrow from the president's terminology. Sentiment has obviously recovered, but rate cut expectations have not moved back up. So it's not like we are seeing the case for rate cuts be diminished. Sentiment is just improving. And so one might surmise that if the PPI numbers told you something whereby this had to move in and you had to diminish the case for easing, then stocks wouldn't like it. But for the moment, that isn't what we're looking at, and ostensibly, as long as this continues, stocks remain in the trend that they're in. We're just going to have to look at that PPI number and see if it gives us any rationale to think otherwise, because it can, depending on what's in it, suggest that what we just saw in CPI is smoke and mirrors. And on the flip side, there is the US dollar. And this is perhaps where things get a little bit more interesting. As the outlook has become more dovish, the dollar has weakened. But as it's anchored around these dovish levels basically since June, the dollar has stopped falling and now appears to be trying to carve out some kind of a bottom. And so, were there to be one takeaway from this current environment, it is that whatever is happening with near-term rate cut expectations, even when they get more sure of themselves, as they appear to get today, the overall outlook for policy is relatively stable, and the dollar's sell-off seems to be leveling out against that backdrop. So whatever one thinks of stocks, the dollar at least seems to be showing signs of what could amount to a trend change versus this blistering sell-off in the beginning of the year. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime. That's a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go from there. I'm likewise on with Chris for Futures Power Hour Mondays and Fridays. On the news and insights portion of tastylive.com, putting all of this same analysis into writing rather than video. Commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading.